and welcome to the Apheleia conference series to 2025. Today we have with us Dr. John Crowley, which is the chairman and CEO of PHGD Group, which brings together a cluster of companies addressing the various dimensions of ideas and consultancy on social transformations, as well as renewable energy solutions. Allow me to introduce you a little bit more, Dr. John Crowley. Before founding the group, he spent 18 years at UNESCO, leading the section for research, policy, and foresight from 2014 to 2021. He was previously responsible for ethics of science and technology and for global environmental change. Before joining UNESCO, he worked as an economist in the oil industry from 1988 to 1995 and as a research fellow at the French National Political Science Foundation. From 2002 to 2015, he was editor of the UNESCO-published International Social Science Journal. He's the author of Saint-Épine, La Rose, Tony Blair, Un modèle pour l'Europe, published in Paris through La Découverte in 1999. He's also editor of Tony Blair, Le Nouveau Travaillisme et la Troisième Voie, also published in Paris in La Documentation Française, also in 1999. He also published Pacifications, Reconciliations, which was a special issue of the journal Cultures and Conflicts, still published in Paris at L'Harmattan, 2001, and Rethinking Human Security, published together in Paris and Oxford by UNESCO and Wiley Blackwell, and published in 2008, together with Mufida Gusha. Dr. Crowley has published also further 100 academic articles and book chapters, mainly on political theory and comparative politics. In Oxford by UNESCO and Dr. John Crowley, welcome and thank you for your availability to be present here. And I'm hearing something in an echo, strange echo. Theory and comparative politics. I don't know what's happening.
Yes, we're hearing a lagged echo of the introduction.
We're hearing a lagged echo. This is unusual, but let's wait. I will now close my micro. The echo continues. So what's happening?
Yes.
Let's wait some seconds, and then that this problem is solved. Let's wait. I will now close my micro. Well, I think it's solved. Can you hear me, John?
Yes, I can hear you fine.
I believe the echo is finished. Let's wait some seconds and then... no, it continues.
It continues.
Well, no hurries. There's an old saying, no hurries, no worries. So let's take it easy and this will be solved. I hope so.
I think if everyone cuts their microphone, including perhaps you, Luis, it should be okay.
It continues. Well, no hurries. There's an old saying, no hurries, no worries. So let's take it easy and this will be solved. I hope so. I think and now, I think it's solved this. I cannot hear anymore the echo. I think so. Okay, the stage is yours, John. Thank you again very much. Let's start.
Thank you very much, Fernando, for the kind introduction. And it's a great pleasure to address the audience, both live and in replay on this occasion. I should add to my biography that I am a board member of Apheleia, and in that capacity, particularly pleased to be able to speak in this context. So I will be speaking on generalized capital or generalizing capital, as you know from the title, and the abstract will have given you some indications as to what I will be talking about. And of course, at the risk of immediately liquidating my audience, I will be talking, among other things, about accounting, which for many people is perhaps the most boring subject on planet Earth, with the possible exception of sports they're not interested in watching. like cricket for the French, for instance. My argument will be framed by the basic idea that accounting is much more important and much more interesting than it's often taken to be, including and perhaps especially if you're not an accountant, which I am not, though I'm obviously much engaged with accountancy as a business owner and have long been interested in its implications. At the risk of slight exaggeration, in the same way that it has often been said that mathematics is the language in which the universe expresses itself, well, maybe accounting is the language in which the economy expresses itself. And certainly to understand the economy without understanding accounting would be something like a contradiction in terms. Which brings me to capital. The word capital in European languages is fascinating because of its rich and complex etymological and semantic scope. As many of the audience will know, being familiar with Latin, it has its roots in the Latin caput, capitis, which means head in the literal sense. And it is thus also cognate with superficially unrelated words such as chief, which comes through the French habit of palatalizing the initial C's in Latin words. Just as castrum becomes chateau, caput becomes chef, and chef means literally, in slightly old French, head, hence the term couvre-chef to talk of a hat or a cap or anything else that covers one's head, but also, of course, the metaphorical meaning of the chef, the chief, as being someone who is at the head of a country, an organization, a network, or whatever. So what is capital in the adjectival sense is what is of chief importance. And this means that the word capital in its economic use, and as we will see in particular in its accounting use, is connected etymologically, metaphorically, and thus semantically, because that's how our relationship to language works, with ideas of importance and significance, and perhaps even rulership. In other words, the economic and financial use of the word capital, which is familiar to everyone, whether or not they have actually read Karl Marx's magnum opus, or for that matter, Thomas Piketty's 21st update of it, is fascinating precisely because of the connotations of eminence, control, and domination that are baked into it. And again, this spreads basically across all European languages and has been taken over into non-European languages on the back of translation of the famous books about capital. The most famous of which is Karl Marx's, precisely because Karl Marx himself was fascinated by the often unacknowledged verbal implications of the word. The simplest possible statement of this web of connections is the basis of early 19th century literature, marriageability, being someone susceptible of being a good match in marriage between respectable people. In the works Austen, as of Balzac, and many others, and in the social mores that they brilliantly captured, people are defined by their income and equivalently by the property from which that income derives. Men and women in these novels and in the society of which they give an account are more or less marriageable according to the pounds or francs, correct for whatever currency matters to your own familiar 19th century literature, they command per year, which are in turn a proxy for the wealth that they, or in the case of young women, their father or guardian, obviously, since that's the kind of society these novels were about, control. You will see many references to someone having 4,000 a year or 200 a year or 50,000 a year in whatever currency might apply. And this defines the marriage market. But in defining the marriage market, also defines the social structure and the economic processes on which that social structure is based, and through which, in turn, that social structure maintains and reproduces itself. Of course, in the novels, fortunately, otherwise they would simply be themselves accounting manuals, the passions interfere with the objective financial calculus, but that's a whole other story. Sense and sensibility will not be the subject of this lecture. But taking that very simple starting point, which is effectively the cultural backdrop against which Marx himself wrote, and he was very familiar with this literature, perhaps more with the French than with the British, and in particular very interested in Balzac, two puzzles arise immediately from the socially impregnable common sense of marriageability, and they together point to what Marx found fascinating, indeed spellbinding, as the style and tone of the economic manuscripts of 1843 and the Grundrisse of 1844 eloquently show, including his attempts to fit everything about capital in his original, largely intuitive understanding of the term into Hegelian logic. The first puzzle is, how is income a stable and reliable proxy for wealth? That's far from obvious. And we know in our own society that it's not a constant of human existence, that income and wealth should be related closely and almost mechanically in such a way that they can be used interchangeably. That requires a context, a social structure, and a series of underlying operations of financial nature that guarantee that proxy equivalence. And secondly, how can the various forms of income and wealth, in particular in the novels and in Marx's writings from a very early stage, land versus various kinds of financial instruments, stocks in companies, or debt instruments, public debt, become essentially equivalent? Now, the answer, of course, is not by some conjuring trick or law of nature, but in specific social circumstances that are arranged precisely to ensure and perpetuate these two forms of equivalence. And as students of Marxism know, generalized equivalence came to be, in Marx's later writings, and in particular in Capital itself, 20 years after his first considerations on the subject, the essential form of what he was to term capitalism. Generalized equivalence, with everything that means, both in terms of social structure, in terms of economic processes, and in terms of Weltanschauung, in terms of relationship to the world, a way of understanding through what the Communist Manifesto calls the cold cash nexus, this principle that everything is price and that the prices of all things are comparable on the same monetary scale. And you could argue that much of 19th century literature is about the struggle between the romantic desire for authenticity and the social pressure for generalized equivalence. I won't go into that again, though it makes me feel that actually that would be a fascinating lecture in its own right. Maybe we can keep it for another time. Now, generalized equivalence, but the whole point of this argument, which I'll be presenting here today, is not quite generalized enough, and generalized in ways that leave important gaps, which from our perspective today require serious reflection. The language of equivalence, which interestingly is also a central term in physics, I won't go into that, but it's interesting how the whole of 20th century physics, particularly under the influence of Einstein, is itself constructed around the idea of equivalence as a foundational principle for the elaboration of schemes of thinking that account for how the world works. The language of equivalence in the economic sphere, similarly, at least in analogical terms, is the language of accounting, which gives us a second complementary way of looking at how capital, the product and form of specific human relationships, can come to be perceived as the generative principle from which those relationships derive. that being precisely the more sociological aspect of Marxist thinking, how we come to believe that this equivalence inscribed in the concrete reality of social relationships is some law of nature that social relationships must conform to. So let's actually talk about accounting in slightly technical terms, because it's both much more interesting than many people think and really important in terms of this challenge of generalized equivalence. In double entry bookkeeping, which means in all accounting systems since the Renaissance, which by methodological principle must balance, double entry bookkeeping is the principle that every operation in the books of a company or any other entity, including entities like public institutions or associations that are not companies, must be written twice in two different forms, so as to reflect both its immediate effect on inflows and outflows and its effect on the balance sheet of the corporation or entity. Capital appears in this respect twice on the balance sheet of a company. And Marx himself found this fascinating. And when you think about it, it is fascinating because it tells us a very complex story about the material, financial, and imaginative organization of the economy. First, capital appears on the liability side of a balance sheet. Let's take a corporation as the simplest case, but again, it can apply to anything, including a whole country in terms of public accounting. The liability side of a balance sheet is the side that shows what accountants call the source of funds. And capital appears among the source of funds as the share capital or equity that holders of shares in the corporation, which may take a number of different legal and technical forms, have provided to it upfront to support its operations, and to which accumulated undistributed profits are over time added or subtracted, of course, when the corporation is losing money. The total of the original share capital and the accumulated profits, roughly speaking, is what's known as the total equity, the capital of the company in the broad sense. In French, very interestingly called fonds propres, the proper funds, the funds that genuinely belong to the corporation, a liability that is owed to its owners and not to some third party. At the same time, and correlatively, capital appears on the asset side of the balance sheet. This is often the left-hand side, liabilities being on the right, but that depends on formatting, which is not universal. And capital appears on the asset side of the balance sheet as a factor of production, something used or mobilized to produce value, which may be further divided into species of capital for analytical purposes, species of capital fixed and variable, intangible and tangible, the notion of working capital, which is central to Marx's whole analysis of how capital drives the economy, and so on. But all of these are species of capital, and indeed, in everyday accounting terms, they are called capital. So how can capital be both a liability and an asset at the same time? It's not the same amounts, typically, though they could, by coincidence, be identical. It's clearly not the same kind of thing, but at the same time, there is an equivalence inscribed in the financial instrument of currency between capital as it appears on the liability side and capital as it appears on the asset side. And there's also an equivalence in terms of interchangeability, since the capital on the liability side is what enables the corporation to pay for expenses upfront in order to derive profit and bring it back to the liability side of the balance sheet as accumulated profit over time. And that to and fro between the two sides of the balance sheet is extremely important in practice and actually theoretically quite interesting. What it means is that capital is the input to the operations and by extension to the economy as a whole, the means and the output, all at the same time. Capital has not two faces, but three. Two in the balance sheet and one, as we will see, in the profit and loss account. And this isn't just a quirk of language. The equivalence between input, means, and output is the essential principle according to which the whole economy operates. And for the avoidance of doubt, you don't have to be a Marxist to say that. I'm not a Marxist, though I'm interested in Marxist thought and have even had occasion to teach it way back in the 1990s. Marx is just one of the people who noticed this and who did it in a rather interesting way. But even if you're completely indifferent to not just to Marxism, but to Marx, you just need a basic grasp of accountancy to get the point that capital has that feature of generalized equivalence inscribed in the inputs to production, the means of production, and the output of production, considered economically and financially as distinct from materially and technically. The easiest way to see this in technical terms from an accounting perspective is to consider the connection between a profit and loss account and a balance sheet. The net profit or loss of a given year, as I said earlier, appears on the balance sheet at year end as a liability, a source of funds, something that can be reused for the productive process. And because the balance sheet necessarily balances by the basic logic of double entry bookkeeping, the net profit or loss is thus necessarily equal, but opposite in sign, to the net change in the entity's assets over time. Sorry, necessarily equal, not opposite in sign, of the same sign as the net change in the entity's assets over the year. Its capital considered in one of its dimensions as means of production. And because accounting is recursive, each year's accounts build on the closed accounts of the previous year, the year's output is also equal to the next year's input of capital in its complementary liability form. In the absence, at least, of exogenous changes, which are very common in real life, of course, such as changes in share capital by increase or reduction in the hands of the shareholders, or changes in indebtedness. You can clearly increase your available capital for production purposes by borrowing money, and that has certain consequences on both the liability and asset side of the balance sheet, which are separate from capital in the technical sense. In other words, income and capital are technically equivalent. They're not two different kinds of things, even though they correspond to very different pictures of the economy, one static, one dynamic, one inherently balanced, the other most likely to be unbalanced. And furthermore, all forms of income and capital are technically equivalent. They all come together in one balance sheet that measures them all on the same scale and allows one single calculation to be made of the increase in value in capital in the liability sense of the balance sheet over some period of time, such as an accounting year. And that gives rise to some very interesting puzzles, which I think are central to the challenges of generalizing capital, which I'm getting towards. The accounting equivalence of income and capital is simply an identity. It is indifferent, to how capital is valued. Whatever arbitrary value you put on any asset, whether physical or not, the balance sheet is always going to balance. Economically, however, valuing capital is an operation of crucial significance, and it's not a simple one. How much is a piece of land worth? How much is a building worth? How much is the work of an employee worth to an employer? How much is a government bond worth? And so on. And you can see where I'm going here. How much is biodiversity worth? How much is the health of the oceans worth? These are arbitrary questions with respect to accounting, which can handle any valuation system whatsoever, but at the same time must at some point ensure coherence between the three dimensions of capital. Because if the valuation is such that there are inconsistencies between input and output, they can be reconciled technically. Accounting can handle everything. But what they cannot do is ensure the equivalence between the various forms of capital and between income and capital that is required for the accounting system and the economic system to be, shall we say, isomorphic in the mathematical sense, to be two representations of the same thing in different frames of reference that ensure equivalence between those frames of reference. Take some examples. A bar of gold, a hectare of land, a patent, an order book. How much are these worth? Now, some assets obviously have a fairly well-defined market value. That makes things slightly easier. You can outsource valuation to an external trusted source of validation. If you have a bar of gold, and I'm very happy for you if you do, or even if you have several under the bed, you can quite easily check its cash equivalent value. At the moment, a kilo of gold is worth about 95,000 euros, which is a lot by recent historical standards. And you can easily check this. It varies from day to day, and there are multiple online sources that can give you that value, assuming you want to sell it, of course, but you may not want to sell it. And recognizing that your title to it is going to affect the transaction value quite dramatically. If you have gold to which you have no legal title, good for you, but recognize that you have a problem, not just a bar of gold, then probably you need to sell it at a 70 or 80%, because the people who are prepared to buy illegal gold charge a very high commission on an operation that has to be kept very discreet. But still, 20% of 95,000 a kilo is still a substantial amount of money if it costs you nothing to acquire the gold. Much trickier is the question, it might be worth X to sell it, but what's it worth to retain it? That's a much trickier idea. What is it worth to me to have a bar of gold? Assuming I'm not a dentist or something, or an electronics company that can use gold for industrial purposes. Clearly, the gold cannot be eaten, as the proverb goes. It cannot directly be spent. It cannot be used to create something, except by being put in an industrial process. And in that case, it becomes simply a raw material. But having it is a form of security, as people say. In times of geopolitical stress, people invest in gold because they feel that it's more secure than other forms of financial instrument, because it is a financial instrument, liquid tradable asset, but at the same time, something more than a financial instrument. It's something you can literally drop on your foot. And as you know, gold is very heavy, so a kilo of gold is actually pretty small. If you have several kilos of gold, enough to break your foot with, that's not going to be a huge amount of gold in physical terms. Think about that question. My apologies. I think I was disconnected for a moment. I hope this won't happen again, and that you can still
Yes,
hear me.
it was only less than half a minute.
Yes, I'm
was
really
very
sorry
brief.
about that.
No worries at all.
Let me come back to the point I was at. Many assets don't actually have a well-defined market value at all. Some because they are completely unique. Think, for instance, about the very interesting problems of managing a professional sports club, where you engage players on expensive multi-year contracts, and each player is essentially unique. They're not interchangeable. And each player has a risk of losing form or becoming permanently injured. How much is a player worth? That's clearly a very complicated question, and it cannot be reduced to the resale value of the plane. Assets that don't have a well-defined market value are often termed illiquid, things that you can't easily sell or only at a very big discount. What's the value of an illiquid asset? Value to the person owning it, I mean, to the person who currently holds it. Tricky question, not an easy one to answer. Here, there are some interesting tensions between accounting and economics, which lead us precisely to where I want to go about the generalization of capital. For accounting purposes, the traditional principle is historic cost. The value of an asset is what it costs to acquire it through investment and or purchase, often a combination of the two, reduced by depreciation in respect of its more or less transitory nature. But of course, this doesn't quite work because it breaks the equivalence principle, since something that costs a lot can be entirely useless as a means of production through bad luck, obsolescence, or in the case of football players, injury, for instance. These things happen. They happen in all kinds of industries. You buy something and it turns out to be completely useless. So its value cannot meaningfully be said to be the value of what you paid for it. All accounting systems, therefore, have workarounds, often rather complicated, which try to bridge that gap between accounting and economics. Those workarounds usually involve a comparison between the economic value of an asset and its accounting value, and require or recommend a write-down, as the phrase goes in accountancy, if the accounting value exceeds the economic value. A write-down is literally writing down the value of something in your balance sheet. You acquired a factory or a store of precious metal or a football player for 1,000, and that person or thing is now worth 200. Therefore, you can't keep it as 1,000 on your balance sheet. You have to write it down to 200 and take a loss of 800, which will appear in your profit and loss account, and therefore reduce your capital on the liability side. These are trivial operations. They're very familiar, and they're one of the ways in which you can bridge to some extent the gap between historic cost accounting and economic valuation. Some accounting systems, particularly in the US, even go further and sometimes allow assets, especially intangible assets such as brands, to be valued upwards when their economic value exceeds their accounting value. This is controversial, and accountants in France, for instance, hate the idea. They find it completely contradictory with what they call prudential accounting, the prudence incumbent on the accountant not to put fictitious or speculative values on the balance sheet. In other words, in order to manage the gap between accounting value and economic value, there needs to be a clear metric of economic value. So what is it? What is the equivalence principle between capital and income, of which accounting gives only an approximation? The answer is simple and probably familiar to many. It's an operation which is often called technically capitalization, which relates an asset to the income stream expected from it, based on certain assumptions. Assumptions about risk and assumptions about discounting, which is a fascinating subject, rather technical, but in fact incredibly rich, including philosophically, that we probably don't have time to discuss here. But you probably may have seen these calculations. To discount is to apply a negative exponential function to future values, typically expressed in terms of X% per year. If you discount at 10% a constant income stream, then next year's income is worth only 90% of this year's, and so on, exponentially until you start to come pretty close to zero, but never quite reaching it for income streams beyond 20 years at a rate of 10%, which means that the future is discounted relative to the present. So that something that produces 100 a year for 100 years is not worth today 100 times 100 equals 10,000, but worth something significantly less, because the future value cannot be fully captured today. There are lots of complicated technical issues about this. Let me just mention one very important one. Nuclear decommissioning. This is of general interest, even though it relates to the technical accounting and economic issues. How much should be put aside to decommission a nuclear power plant? Something that will happen, assume a plant built new today that has a normal operating life of 50 years that can probably be extended to 80 and will need to be decommissioned in 100 or 120 years. You can have an estimate of the present cost of decommissioning if it happened now, but how much money are you required to put aside, if there is such a legal requirement, to cover the future cost of decommissioning? Answer, it depends entirely on the discount rate. If you pick a high enough discount rate, the decommissioning cost becomes trivial. If you pick a low discount rate, the decommissioning cost becomes very high. This is absolutely crucial to the economics of nuclear power. Whether you like or hate the idea, it's a key economic variable, and it raises some interesting philosophical questions about how we should value future costs today. And you will notice that at a more generic level, with perhaps less clearly defined economic metrics, everything to do with climate change, biodiversity loss, loss of ocean vitality, fresh water scarcity, are connected to this question of discounting. Things done now that will have costs long in the future need to be taken into account in today's action. But on what basis? On the basis of what present valuation of the future? Tricky, fascinating. And this is precisely how, coming back to the beginning, the metric of marriageability operated in the presumptively stable world of the post-Vienna aristocratic and bourgeois Europe, about which Austen, Balzac, and others wrote, and which fascinated Marx and others on the radical side of politics. A time in which property was distributed in a very unequal and reasonably stable manner, a time of deflation in which constant incomes were not eroded over time, a time, therefore, in which discount rates could be considered very low, a time in which interest rates were low and stable, so that someone owning government debt of a certain amount could rely indefinitely on an income strictly correlated to that amount of wealth. Or equivalently, someone owning a certain number of hectares of land could rely on, not that anyone used hectares in the novels of the early 19th century, could rely on an income stream that could be predicted with considerable certainty. Once that relationship breaks down, many things start to change, including the marriage market. Late 19th century literature has very different perspectives on all of this, partly because all of these stable relationships have themselves been destabilized. But again, I won't go too far into literature. So far, so good. We can see how capital operates on a balance sheet in a profit and loss account and how accounting visions of capital connect to economic visions of capital. Let's now switch things around and look at the balance sheet to consider not what's in it, but what isn't in it. To consider, as in a famous Sherlock Holmes story, the dogs that are not barking, or that are barking but very much off the premises in this case. There are some interesting examples of the word capital used in this connection. Social capital, a very commonly used word. There's a huge literature on social capital. Human capital, a very commonly used word. There's a massive literature on it. Natural capital, massive literature on that too. Where are they on the balance sheets of our entities, even public entities? Essentially nowhere, except for some marginal additions in terms of natural capital over the past 20 years or so, in response to some technical developments and some political institutional agendas, particularly on the part of institutions like UNEP and the World Bank. If they're not there, two possibilities. Maybe they shouldn't be called capital at all. Maybe it's the wrong word. We should call them something else because they are not, in fact, forms of capital. Or, alternatively, they are forms of capital, in which case there has to be some reason why they're not being included. And those reasons are interesting and potentially important. Let me take a few examples. Social capital, two examples which are of interest to me professionally. One is culture. Culture is, among other things, a lubricant of social relations, including the most obvious example, which is language, but also extending to a wide range of other taken for granted assumptions and ways of operating that allow people to work together without needing to build in advance the conditions on which they work together. Multicultural organizations have higher transaction costs, though they may have other compensating benefits. And of course, culture isn't just an internal issue within organizations, it's also a source of value in its own right, through imagination and creativity in particular. Some of you may know, and I take the opportunity to announce it, we've agreed in the next Apheleia conference in Nassau in April to devote a session on the 8th of April to the question of culture in the Sustainable Development Goals. Trying to understand culture is just as missing from the Sustainable Development Goals as it is from accounting systems. Trying to understand what's at stake and why it matters. It so happens that I'm working on this as a consultant to an NGO campaign called the Culture 2030 Goal Campaign. We'll be talking about this in the context of Apheleia shortly. Another good example of social capital is trust, which has some of the same features, but with different connotations, since trust doesn't so obviously depend on shared backgrounds and can be more an emergent property of familiarity and established working relations. As it happens, as a consultant, I'm involved with one of my companies called Trust Inside in developing models, concepts, and tools to assess trust within organizations and to see the extent to which lack of trust by creating transaction costs is a kind of negative factor of production that interferes with the ability to derive value from other kinds of capital. What this suggests is that while trust and culture may have multiple other features, they are genuinely aspects of social capital in a sense that is strictly equivalent to the kinds of capital we were discussing earlier. They are, in principle, a means of production that can be mobilized, used, not necessarily destroyed, possibly even enhanced by the process of using it to create value. Human capital. Examples are education and science. And of course, the training, professional training related to both, by which corporations or public institutions equip their employees with enhanced human capital in order to make them more productive. But if human capital enhances productivity, then it's a factor of production, and it's nowhere on the balance sheet. Labor is a cost that appears as a cost in the profit and loss account, but it's not considered capital. course, Marx was fascinated by this, but I'm not going to describe or discuss the labor theory of value that he developed to account for this apparent discrepancy. The fact that the most important factor of production seems to be missing from a statement of what constitutes capital. Interestingly, you will note that I've said culture, education, science among forms of social and human capital, which sounds very much like the brand and institutional remit of UNESCO. Maybe it's no accident that I worked for that organization for 18 years. And then, of course, natural capital, which is perhaps better known and certainly better developed in technical terms as a form of capital, more from a public sector perspective than from a private sector perspective, but still, it's increasingly recognized through concepts such as ecosystem services that the natural world is a means of production. That's been known for a long time. Land and minerals and so on have always been recognized as means of production. But that in addition, the sources of those services, such as land again, or such as species of animals that provide useful services like bees, which pollinate flowers and so on, are forms of capital that can be maintained, enhanced, or degraded over time by the way in which they're used in the process of production. You can, in fact, pull all of those three together, social capital, human capital, and natural capital, as being exemplifications of what economists call the theory of the firm. Why do we have entities at all? In a purely abstract economy, where all value is produced by exchange, why not simply have individuals alone exchanging their assets and liabilities in such a way as to maximize their own welfare? Why do you need firms on top of that? There's a whole literature on the theory of the firm. And the usual justification for the existence of companies or other kinds of entities is their ability to reduce transaction costs and to turn inputs into capital by capturing for their own purposes some of that value. For instance, the value of trust and culture and education within a workforce and within the procedures of an organization. These are quite intangible forms of value, but they determine the extent to which a corporation, for profit-making purposes, can extract value from its more tangible inputs. They describe its, or they shape its production function, as one could say economically. So the idea that there are forms of capital that are completely neglected in routine, familiar accounting systems is actually pretty straightforward. And they exist in exactly the same sense as other kinds of capital. They can be derived by capitalization from the income streams that they enable generation of. So in that sense, no, I don't think we can say that capital is being misused in these phrases. Let's look at the two ways in which capital can be valued in the ordinary accounting sense and see to what extent they apply to other forms of capital. On the cost basis of valuation, these forms of capital can in principle be valued, but are often in fact acquired free. This is the case in particular of many aspects of natural capital. And this is one of the economic problems with natural capital. Because it is acquired free, as a public good or as private appropriation of something that could in principle be a commons, it is valued at zero, and therefore its destruction in the production process is not regarded as a loss of value, whereas in fact, taking a broader perspective, it should be. And this is clearly seen when you adopt the economic basis of valuation, where it is very obvious that there are revenue streams attached to the, shall we say, the non-standard forms of capital to which I referred. The best known example is bees. So just a word about bees, because it's easy to understand and interesting. Everyone knows intuitively that bees are very useful to humans. There's a word attributed to Einstein that if the bees disappeared, humanity would disappear within, I think it's 3 years or something, through loss of crops and more generally loss of ecosystems. The labor that bees do is essentially free labor, though of course some bees are domesticated and there is labor involved in maintaining the colonies of bees. But wild bees also provide useful functions with absolutely nothing in exchange, except perhaps our human presumption that they enjoy doing it and are therefore happy to provide benefits for humans on top of living their lives as bees. How can you value that? Interesting question, interesting technical question. And the way it's been done is the following. There are some plants that for various reasons cannot rely on natural pollination. The most interesting example, and it's very extensively studied in the literature, is vanilla. Vanilla, which as you know is an epiphytic orchid, is originally a plant from Mexico, which was exported during the colonial period to the Indian Ocean, where it is largely cultivated today in places like Mauritius, La Réunion, Madagascar, and so on. In its native habitat, certain part of Mexico, that orchid was pollinated by a very specific local species of bee, which was not exported with the plant and doesn't exist in the Indian Ocean. Therefore, and you can check this, this is simply a true fact, vanilla has to be pollinated by hand, by humans. Humans walking around with little brushes, putting pollen in the right places in the flowers at the right time, which is one of the reasons why vanilla is so expensive. The cost of pollinating vanilla through human labor can be quite easily calculated. The ecosystem service that bees are not providing for vanilla is essentially the avoided cost of that labor. And once you have a metric for that, you can extend it to other things. There is all the plants that require pollination. And the answer is that probably bees are providing ecosystem services of something of the order of tens of billions of dollars per year to humans, simply by the fact of being bees. And we get that free. That's capital. Capital that needs to be maintained in our collective human balance sheet. And if the bees are declining, and as you probably remember, there was a big fear of bee colonies collapsing under the influence of various kinds of pesticides about 10 years ago, it seems that reduction in use of those pesticides and perhaps adaptation on the part of the bees has stabilized this in a number of parts of the world where they appear vulnerable. But losing the bee colonies is losing that economic value. And by extension, you can look at the ecosystem services provided in terms of carbon sequestration or in terms of oxygen production, in terms of maintenance of soil quality or anything else you care to name, in terms of the cost of the non-natural alternative to maintenance of that capital. And that cost is considerable. According to a recently published study, admittedly by an advocacy group, the total value of all ecosystem services provided to humanity is actually greater than global GDP, or so they claim. I only saw this the day before yesterday. I haven't had time to dig into the methodology to see whether it stands up to scrutiny or not. But that at least was the headline figure. And this can be extended, of course, to all of the things I was talking about, including, for instance, the question of the value of public investment in culture, which is not just about the economic value of cultural products as bought and sold, connected, for instance, to cultural tourism, but also about the extent to which public investment in culture contributes to an ecosystem of capacities, competences, and relations that contribute positively to the ability of corporations, non-profit associations, public entities, and so on, to produce value through their own operations by relying on a background condition. Questions about science are very similar. The idea that you invest in the science you need to produce the technology you need is surprisingly and regrettably common, but makes no sense whatsoever, because no one knows exactly. You can't reverse the innovation pipeline. You can't work backwards from the innovation you're trying to achieve to the science you need to achieve it. And both innovators and scientists know this. So you need a vibrant, broad ecosystem of science, including the social and human sciences, in order to create the conditions, including through serendipity, for innovation to occur. This is well known, often not recognized by public funders concerned to save money, but easy to understand in principle. So let me just say it bluntly as I come towards the end. Social capital, natural capital, human capital are genuinely capital. So why are they absent from accounting systems? Either completely absent in some cases or very poorly represented in others. And I'd like to mention 4 issues, all of which are technical, but also conceptual and ideological, and in the combination of which represents, I think, the agenda that I would certainly like to suggest as a kind of framing meta agenda for studies to come on the part of those who find these things interesting, in terms of the generalization of capital. Recognizing, as I said from the very beginning, that you can't generalize capital without generalizing accounting systems, because that is the language in which the economy expresses itself, just as general relativity expresses itself in mathematics. First of all, first difficulty, the technical valuation problems, which are connected to appropriation and attribution. When something is uniquely owned by an entity, public or private, and produces income streams exclusively for that entity, the valuation problem on an economic basis isn't trivial, but it's not unmanageable. But in the case of many of the things we're talking about, skills, culture, trust, it's not fully appropriable, because building background conditions of trust can be captured by people who contributed nothing to building the conditions, and not fully attributable, because these factors of production always work in combination with others. Now, this is a general problem of production functions. Even the connection between capital and labor is a double variable function that requires careful analysis. But things get much more complicated when you're talking about things such as trust, which is a very good example, which are clearly valuable, but to which it's difficult to attribute a specific income stream unless you can run experiments, and this is possible both in the lab and in the wild, comparing low trust and high trust configurations of the same business, for instance. And entities themselves can run this internally as an experiment to find metrics to value trust, and therefore give themselves good reasons to build and maintain trust or creativity or ecosystem services or any of the other things we're talking about. So the technical valuation problems are significant, but not insurmountable. Secondly, the appropriation issues. There is, in the case of what we might generically call public goods, which is a tricky term, it has a very precise technical definition, but also a much looser generic definition, between property, use, and control. Who owns it, who benefits from it, and who gets to decide how it's used. The traditional image of property is that it bundles together ownership, use, and control inseparably. And there's a very strong legal and ideological basis for this within many systems that we're very familiar with in Europe and North America in particular. Indigenous knowledge systems and traditional pre-modern ownership systems were often very different. the principle of commons, for instance, which still exists in an interstitial way in many European societies and is dominant in many parts of the world, is a principle that strictly separates ownership, which belongs to the community, from use rights and rights of control, which belong to individuals or groups within the community on certain conditions consistent with community ownership. This is an interesting model, a complicated one of unbundling the notion of property so as to identify those three features separately. Accounting systems are traditionally based on unitary ownership, but they don't need to be. And a good example of this is that most legal systems in Europe, certainly in France, certainly in the UK, allow specific unbundlings of property for specific purposes. A very good example is unbundling ownership of a house from use rights related to that house. This is very, very common, particularly in inheritance situations. Someone owns the house, someone else has the exclusive right to live there. No problem. Everyone's familiar with this. And it can be captured in an accounting system by a valuation that recognizes the value to the user of the use and to the owner of the ownership. This is entirely possible, but it requires work, and in some cases requires not just technical work, but different modes of organization. And as you probably know, there are many movements around the world calling for the reinvention of the idea of the commons, various kinds of commons, connected to public goods at various levels, using traditional models, but also radically new models, such as digital commons, in order to allow forms of capital that don't fit within standard accounting systems to be integrated within them. This, of course, connects to the third question, which is, if capital, natural, social, human, is to be on the asset side of a balance sheet, it has to be on the liability side as well. But that means that there has to be a clear understanding of whose capital it is. Sorry, Fernando, are you calling my attention to the passage of time?
Yes, I do. I didn't want to interrupt you because it's very interesting, but I decided to raise my hand. Usually, it's been very interesting, but usually we have 45 or 50 minutes for talking and some time also for questions. So
Okay.
far, I don't see any questions.
I'll finish in 5 minutes.
But okay, great. And then we can stay a little longer and discuss some ideas. Okay, if you okay, please carry.
Thank you.
Thank you.
So whose assets are they? And unbundling ownership works fine in terms of the assets on the asset side and their economic valuation. It allows, in particular, something to be split between different balance sheets in its different varieties. It looks a bit more complicated, but can be resolved technically on the liability side. And finally, the ideological issues. It is no secret, nothing original at all in what I'm saying, that the economy of modernity is an economy of extraction, which has prospered on the basis that certain things could legitimately be destroyed in order to produce value. They could be destroyed either because they were valueless, because they belonged to no one, or because they were inherently replaceable. And humanity has often assumed that certain things were replaceable, which were not. Extractivism sometimes bites its own leg off, as when the Vikings deforested Iceland, assuming that the trees would regrow quickly, and discovered to the horror that trees grow very slowly in Icelandic conditions. The Greeks similarly deforested the islands of the Aegean in, we think, about the 3rd or 4th century BC, and discovered that once the trees are gone, they don't grow back. A combination of goats and soil erosion guarantee that what is barren remains barren. So extractivism can sometimes reach its own limits internally, but at other times it doesn't, or at least the external sink is big enough that we feel we can throw things in indefinitely and its capacity for absorption will never be exceeded. We thought we could dump anything in the ocean and the ocean could handle it. We're perhaps coming to realize that that wasn't true. We thought we could dump anything in the atmosphere and the atmosphere could always handle it. We're beginning to understand that that wasn't necessarily true, that there isn't an outside. And much of our historical economic development since the Renaissance has been about finding an outside to colonize. If there's no outside and nothing left to colonize, then we have to rethink extractivism. That's not just a technical challenge, it's a political, ideological, philosophical challenge as well. And we won't necessarily escape it by trying to colonize Mars, even though Mars might appear to be the ultimate outside. This, therefore, is what I mean by generalizing capital. It's a program for thinking and research as much as it is a set of answers. And I hope you found it interesting and that it might encourage you to regard accounting with a slightly more benevolent eye than you have traditionally. Thank you.
So, thank you very much, John, for this interesting presentation. We don't have questions on the YouTube chat, but you gave good news about your roundtable here in Apheleia in April. And I would like that in that roundtable or event, I don't remember the exact name that you mentioned, I would like that if you could develop more some ideas that you presented here, as for example, culture as capital and education as capital. Probably we don't have time because this would lead us to a long discussion. And indeed, they are very interesting subjects. But I say it again, I would like that please don't forget to develop a little bit, because this will be interesting and fundamental for the moment that this world is living, with the lack of education, lack of culture, lack of knowledge, and many strange things going around. I don't want to be pessimist, but it's the reality. But discussion gives birth to light, as we say, not in these exact words, Portuguese and probably also other countries' proverb, but it's of course it's very important. What some things that most of the things that we said were very important, and thank you again. I would like that we will finish the broadcasting in in a minute or even less. I'd like if you can stay with us 2 or 3 more minutes.
Of course, with pleasure.
Okay. Portanto, Ricardo, fechávamos a transmissão. Ricardo?